If you're clicking on today's video, you may be a little worried about what to expect with your money heading into 2024. We have a pending election year. You may be hearing from your coworkers that the crash is coming. You may be thinking to yourself, should I take a year off? Should I sell everything to cash and get through the election year? What we're going to talk about here today is the impacts of trying to time the market and really the negative impacts that may have. As the great Warren Buffett has said many times, it's about time in the market, not timing the market. For those of you new here, my name is Andrew Toccaceli, Senior Vice President here at W.A. Smith Financial Group. We are a team of fiduciary advisors based out of Ohio, working with individuals all across the country, and really here to teach you all things financial, provide financial peace of mind for you. So, biggest concern we see many individuals having here today are the election year that is coming up here in 2024. Drop some comments below if you have other concerns heading into 2024, but I know the election year is probably one of the biggest. And we see it all the time. We're hearing people who maybe want to take a break from the market. We've had a very successful 2023, major rebound coming off of 2022, and it never fails that an individual wants to maybe take a break. So what I want to share with you today is the impact of trying to time the market. I have a great diagram that I'm going to share with you here in a second, but before I even get there, let's think back to the last time we saw major volatility over headline news, if you will. So what I mean by that is 2022, we saw consistent downturns in the market, but the last time we had major volatility due to a headline or an impact happening in the world was February, March, April of 2020 due to the pandemic. If you were an individual at that time who panicked and began to sell out of your equity strategies in, let's say, late March when the S&P was just on a massive decline, think of the impact that would have had on you, on the losses that you would have realized at that point. As we saw in 2020, markets recovered very quick, and generally within about 4 months from the bottom in March, markets were already setting all-time highs again. So for those individuals who tried to time the market and get out, number one is, when did they get back in? They may have missed out on all of that 2020 return, and potentially even 2021, which was a very positive year. So, when you start playing the timing game, you got to be right twice, right? You have to be right getting out at the right time, but then you have to be right again entering the market. I've seen individuals maybe get one of those right. Maybe they get out at the right time, but they don't know when or they don't know how to get back in, and the losses they end up losing on that offset the gains that they got by getting out early. So let's look at 2023. All right, so if you take a look at this chart, we're going to share with you the effect of missing the best days in the market of 2023. We're really looking from December 30th of 2022 through November 30th of 2023. The S&P 500 over that time, as you can see, was up 18.97%. Now, if you tried to play a timing game throughout the year and you happen to just miss the 5 best days of the S&P 500, your return drops all the way down to 7.9%, almost an 11% difference just by missing the 5 best days. We look at missing the 10 best days, that return goes negative. You now have a negative 0.68% return over that 12-month period just by missing 10 of the best days. 15 best days, your return goes to negative 7.55. And if you miss the 20 best days, so maybe a longer period of time that you were out, you have a negative 13.4% rate of return. So, hey, look, our crystal ball is broken. We can't always know exactly where the market's going, but as I mentioned earlier, it's about time in the market, not timing the market. I know many individuals are concerned, again, with the impending election. From 1937 to 2021, the S&P 500 has been up 9.9% on average during election years, about 12.5% during non-election years. Take that with a grain of salt. Again, it's more about underlying macro trends. What kind of business cycle are we in versus the election itself and the headlines that come with it, creating the losses in the market over time. So again, what we focus on here is making sure that individuals stay disciplined to their financial plan. As long as you do not see yourself needing the dollars that are at risk, for 12 to 18 to maybe even 36 months, then stay disciplined to your risk profile, and generally the market will prevail. So we don't want to see individuals fall victim to trying to time the market. I just shared with you what those results could potentially look like. So I want to hear from you guys. Drop some comments below on any concerns that you may be having. We'll produce some additional videos based on those concerns, talk you through this. But we look forward to all of you having a successful 2024. Again, if you like today's video, make sure that you subscribe to our page, turn your notifications on so that you don't miss future content. Till then, see you next time.